What if buying a house, the so-called American dream, is actually one of the biggest financial traps of your life? Warren Buffett, one of the greatest investors in history, just issued a rare warning. And it's about real estate. The same man who once said he'd buy hundreds of homes if he could, now wants nothing to do with the housing market. So if you're thinking about buying a home in the next 12 months, stop. Because once you hear what Buffett knows, you might realize you're about to walk into a wealth-destroying decision. Back in 2012, Warren Buffett said something that made waves across the financial world. The housing market had just collapsed. Home prices were down 30 to 50% in many areas. Foreclosures were everywhere. The economy was still shaken from the Great Recession. And in the middle of that chaos, Buffett calmly stepped onto a CNBC set and said, "If I had a way of buying a couple 100,000 single-family homes, I would load up on them." He wasn't joking. To him, housing at that time wasn't just cheap. It was a once-in-a-generation opportunity. Low interest rates, distressed prices, high rental demand. It was the perfect storm for wealth creation. He compared homes, especially rental properties bought at low rates, to stocks, and even said they might be the better deal if you were willing to manage them. And remember, this is Warren Buffett. The man who made his fortune in the stock market was publicly saying housing might beat stocks under the right conditions. But here's what most people missed. He never actually went out and bought hundreds of homes. Why? Because even then, even when the math was screaming buy now, Buffett knew something the average investor didn't. Real estate is inefficient, illiquid, slow, and tied up in emotions. And now, over a decade later, he's not just staying away. He's sounding the alarm. At his most recent shareholder meeting, Buffett explained why he's no longer interested in buying real estate, not even in a down market. He said, and I quote, "It's so much harder than stocks. There's just so much more opportunity in the securities market than in real estate." Let that sink in. This is coming from a man who has outperformed the market for over 50 years. A man who built one of the most successful investment portfolios in history. And now he's telling you, not subtly, not cautiously, but directly, real estate doesn't offer the same advantages it once did. Not in this environment, not at these prices, not with today's interest rates. And the reason isn't just about returns, it's about effort versus reward. Buffett pointed out that when you buy a stock, you can do it in seconds, one click. No emotion, no haggling, no paperwork. You can buy and sell hundreds of millions in equities without a single phone call. The market is liquid, transparent, and brutally efficient. Now compare that to buying a house. You find the listing, negotiate the price, schedule inspections, wait for appraisals. Deal with repairs, closing costs, banks, insurance, title companies, and then maybe, just maybe, you own it. But then the work really begins. Because now you're the landlord, the manager, the repair coordinator, the taxpayer, the maintenance guy. And all of that for what? An average return of 4.3% annually, just 1.3% above inflation over the last 100 years. Sure, you can do better with rentals, right? Maybe, if you're lucky, if you have time, if you're in the right city. If nothing breaks, if your tenants pay on time, if interest rates don't eat your cash flow alive. Buffett's view is simple and brutal. Unless you're a full-time investor with systems, teams, scale, and access to below-market deals, you're probably wasting your time chasing returns you could get more easily with a low-cost index fund. That's why he stopped buying real estate as an investment, not because housing is bad, but because the opportunity cost is massive. In his words, real estate deals with individuals. To them, it's an emotional decision. With stocks, it's just numbers. That's the secret. Stocks don't argue. They don't need repairs. They don't care about inspections or closing delays or emotional sellers. They just produce, or they don't. And that's why Buffett, one of the greatest investors of all time, prefers securities over single-family homes every single time. So when a man worth over $130 billion is telling you to think twice before buying a house, maybe it's worth listening, because the opportunity you're chasing might just be a distraction in disguise. For decades, we've been sold a simple story: buy a house, build equity, get rich slowly. It's the safest investment you can make. Parents repeat it, teachers promote it, financial advisors reinforce it, and society celebrates it, as if owning property were a universal badge of success. But here's the uncomfortable truth. Buying a house is not always an investment, and in many cases, it's not even close. Let's break down the illusion. Most people believe that real estate is the ultimate path to wealth because it's tangible. You can touch it, walk through it, show it off, decorate it. There's a deep psychological satisfaction in saying, "I own this." But here's the catch. Psychological satisfaction doesn't pay you back. And just because something feels like an investment doesn't mean it functions like one. Warren Buffett, the man who has mastered the art of identifying real value, has warned about this very trap. He explains that people confuse ownership with profit and confuse stability with growth. Let's be clear, a house can be many things: a home, a shelter, a status symbol. But that doesn't automatically make it a wealth-building asset. An investment is something that pays you. A house, especially the one you live in, does the opposite. It takes your money every single month. Mortgage payments, insurance, property taxes, HOA fees, maintenance, repairs, renovations, landscaping, pest control, broken water heaters, leaky roofs. Even when the market is up, your expenses never stop. And if you want to move, be ready to pay closing costs, commissions, staging fees, and maybe even capital gains tax. Meanwhile, stocks don't call you at midnight because the toilet exploded. They don't require $20,000 when the HVAC fails. They don't demand emotional energy or physical labor. They just perform, or they don't. But real estate, we're told, is safe. It's what responsible adults do. And that myth is so deeply ingrained, people will go into hundreds of thousands of dollars in debt just to say they own a piece of dirt and drywall. But what they rarely calculate is the true cost of ownership. Think about it. The average home appreciates around 4.3% annually. Inflation averages about 3%. That means your real return, the money you actually keep above inflation, is just 1.3% per year. And that's before you subtract all the other costs. Compare that to the S&P 500, which has averaged nearly 10% annually with dividends reinvested, with zero maintenance, no management, and full liquidity. Still think buying a home is the smartest move? Warren Buffett doesn't. He sees beyond the emotional narrative and looks at the numbers, cold, clear, and logical. And what he sees is this: most people are buying houses not because it's financially optimal, but because it's emotionally satisfying and socially accepted. They're not thinking like investors, they're thinking like consumers with a mortgage. That's the real danger. We're taught that renting is throwing money away, but rarely do we stop to ask, what if owning is just throwing money into a slow-moving, expensive liability? Buffett's insight forces us to confront a brutal question. Are we building wealth or just buying into a belief? Because if you're working harder to make less, stuck in a property you can't easily sell, paying for problems you didn't expect, then maybe, just maybe, the house isn't working for you. You're working for the house. And that's not an investment, that's a trap disguised as stability. Let's take the emotion out of this and look at the raw numbers. If you bought a median home 100 years ago and held it, what would your annual return be? Just 4.3% a year. Sounds decent, until you realize inflation over that same period averaged 3%. That means your real return after inflation was just 1.3%. And that's before you subtract all the hidden costs. Property taxes, homeowners insurance, maintenance and repairs, vacancy, if it's a rental, HOA fees, renovations, closing costs, agent commissions. When you add it all up, that modest 1.3% return can quickly become negative. Now let's compare that to the stock market. The S&P 500 has returned, on average, 9.8% annually since 1928, with dividends reinvested. That's not a guess. That's nearly a century of performance. And here's the kicker. You don't need to fix a leaking pipe. You don't need to vet tenants. You don't need to negotiate with banks, inspectors, or escrow officers. You click a button and you're in. Now let's go even deeper. Say you put $50,000 down on a $500,000 house in 1995. That house appreciates at 4.3% per year, and today it's worth about $844,000. Sounds great, right? But now let's take that same $50,000 and invest it in an S&P 500 index fund in 1995. That grows, without leverage, to over $940,000 by 2023. And if you were reinvesting dividends along the way, you'd be well past the $1 million mark without ever lifting a finger. And we haven't even talked about time. Buying real estate isn't just capital intensive, it's time consuming. You have to find deals, analyze neighborhoods, meet with brokers, handle paperwork, coordinate inspections, negotiate terms, fix broken appliances, deal with permits and insurance, respond to emergencies. All of that takes hours, weeks, months. Buffett calls this the invisible cost of effort, something most people never account for when they brag about their real estate return. So even if your property earns 6% annually, what was the actual return per hour of work? Because with stocks, there is no hourly commitment. Buy, hold, wait, repeat, no drama, no noise, no tenants calling you on a Sunday morning. Let's not forget about liquidity. With real estate, selling can take months. You need a buyer, you negotiate, you pray the financing goes through. With stocks, you're in and out in seconds, anywhere in the world. Buffett put it simply, in real estate, when you make a deal, then people start negotiating more things and more things. It's a whole different game. And that game is rigged with friction. Real estate is opaque, slow, emotional, and full of inefficiencies. Stocks are fast, transparent, and ruthlessly optimized. Still not convinced? Let's talk about downturns. Historically, the stock market crashes hard, but also recovers faster. The housing market, on the other hand, is sticky. It can take years or even decades to rebound. Example, after the 2008 crisis, some US cities took over 10 years just to return to pre-crash values. Meanwhile, the S&P 500 bounced back in under 4 years and kept climbing. Buffett's logic is simple. Why tie up time, money, and energy for a lower, slower, and more stressful return? You don't need to be a billionaire to think like one. You just need to understand that numbers don't lie, emotions do. And if the math doesn't make sense, the story doesn't matter. If you want to understand wealth, you need to understand how the wealthy think, not just what they do. Because the biggest difference between the middle class and the ultra-rich isn't just income, it's perspective. Let's talk about how that plays out when it comes to buying a home. Poor mentality. The average person sees buying a house as the ultimate milestone, a symbol of success, a rite of passage, proof that they've made it. They say things like, renting is throwing money away. Real estate always goes up. It's better to own than to pay someone else's mortgage. So they save up just enough for a down payment, stretch their budget to the limit, and lock themselves into a 30-year mortgage. Then what? They spend the next decade funneling money into maintenance, taxes, repairs, insurance, renovations, furnishings, all while hoping the value goes up someday. They treat their home like an investment, even if it never pays them a single dollar of return. Why? Because they've been conditioned to believe that ownership equals wealth. But ownership alone is not a strategy. Now let's flip the lens. Rich mentality. The wealthy ask one question before every financial decision. Will this asset put money in my pocket or take money out? That's it. That's the filter. They don't buy for prestige, they buy for performance. So when it comes to real estate, they're not thinking about white fences and open floor plans. They're thinking about cash flow, yield, risk-adjusted return, leverage efficiency, market cycles, exit strategy. If a property doesn't produce consistent income or appreciate significantly, it's not an investment, it's a liability, plain and simple. And if they do buy a primary residence, they don't pretend it's a financial engine. They know it's a lifestyle decision, not a wealth strategy. That's why Warren Buffett still lives in the same house he bought in 1958. It's modest, paid off, stable. He didn't buy it to flip. He bought it to live in, and he didn't confuse that with building his fortune. The wealthy separate emotion from investment. They don't chase status, they chase freedom. Now here's the paradox. The middle class often goes into massive debt to look like they're rich. The rich make strategic moves to stay free, even if that means renting, downsizing, or waiting patiently for the right opportunity. Because real wealth isn't about how big your house is, it's about how little you depend on it. The average person builds their life around their home. The wealthy build their home around their life. Here's a comparison to drive it home. Middle-class thinking. My house is my biggest asset. Wealthy thinking. My house is a cost. My investments are assets. Middle-class thinking. I need to buy now before prices rise. Wealthy thinking. I'll wait until the numbers make sense. Middle-class thinking. I'm paying off my mortgage early. Wealthy thinking. I'd rather use cheap debt and invest the difference. Middle-class thinking. I want to own where I live. Wealthy thinking. I want to invest where the returns are best. Middle-class thinking. It's better than renting. Wealthy thinking. What's the return on my time, money, and energy? Warren Buffett said, the most important quality for an investor is temperament, not intellect. And that's exactly the point. The people who get rich aren't always the smartest, but they are the most rational. They resist the emotional pull of conventional wisdom and follow the numbers, the logic, the truth. And in 2025, the truth is this: buying a house isn't always smart. Sometimes it's just a socially accepted way to bury yourself in debt while calling it equity. So the next time someone tells you that renting is throwing money away, ask them this: is throwing money into taxes, interest, insurance, and maintenance on a property that doesn't pay you any better? Because in the end, it's not about owning property. It's about owning your freedom. And the wealthy? They never trade freedom for granite countertops. Let's put everything we've talked about into a simple, real-world scenario. Two people, same amount of money, two very different outcomes. Meet Alex and Jordan, both are 30 years old, both have saved up $50,000. Alex decides to buy a house, like everyone told him to. Jordan decides to invest that same amount into the S&P 500. Let's follow what happens over the next 20 years. Alex, the homeowner. Alex uses his $50,000 as a 10% down payment on a $500,000 house. He gets a 30-year fixed mortgage at 7% interest. That means a monthly mortgage payment of about $3,000, not including taxes, insurance, and maintenance. Over time, the house appreciates at the historical average of 4.3% per year. After 20 years, his home is worth about $1.15 million. But wait, that's just the gross value. Let's subtract the real costs. Over 20 years, Alex pays $720,000 in mortgage payments, interest plus principal. He spends around $150,000 on property taxes, insurance, and basic maintenance, another $30,000 to $50,000 in major repairs or renovations, plus $30,000 in closing costs, fees, and commissions when he eventually sells. Total out-of-pocket, over $900,000. Now consider this. Most of Alex's gain is just the appreciation of the property. On paper, he doesn't actually pocket that money unless he sells, and when he does, he'll likely need to buy another home, paying inflated prices all over again. And unless he rented part of the home or ran it as a business, the house never paid him a single dollar. Jordan. The investor Jordan, on the other hand, puts his $50,000 into a low-cost S&P 500 index fund. He doesn't stress about repairs. He doesn't worry about rising insurance premiums. He doesn't fix roofs or chase plumbers. He just automates $500 per month in additional contributions and lets time do the work. After 20 years, with average returns of 8% annually, his portfolio is worth approximately $750,000 to $900,000, depending on dividend reinvestment and market timing. He can sell it in seconds with minimal tax impact, thanks to long-term capital gains rules or tax-deferred accounts. And if he wants income, he can just withdraw 4% annually, a safe withdrawal rate, and generate $30,000 to $36,000 per year indefinitely. No property taxes, no tenants, no leaking toilets, just clean compound growth. The verdict. Alex owns a house that made him feel secure, but quietly drained hundreds of thousands of dollars over the years. He can't easily tap into that equity unless he sells or borrows against it. And he's tied to a physical location with limited liquidity and a constant stream of hidden costs. Jordan, meanwhile, has built a liquid portfolio. He can live anywhere. He has freedom, flexibility, and cash flow, and he didn't have to manage a single thing. This is not an anti-home ownership message. It's a pro-strategy message. If Alex had bought his home below market value, house-hacked it, or rented out rooms, maybe it would have worked. If Jordan had panicked during a market crash and pulled out his money early, maybe he would have lost. But the point is this: a home isn't a guaranteed investment. It's a tool, and if you misuse it, it becomes a trap. Warren Buffett didn't build his empire flipping houses. He built it buying businesses that produced cash, reinvesting intelligently, and focusing on high-leverage, low-effort systems. So when someone asks, "Should I buy a home?" the real question is, what's your goal? Comfort or cash flow? Because if it's cash flow, maybe it's time to stop looking at real estate as a trophy and start viewing it as what it truly is: a high-maintenance, low-liquidity, emotionally charged asset. That doesn't always deliver what it promises. Let me ask you something. Have you ever felt pressured to buy a house, not because it made financial sense, but because it's what everyone else expected you to do? If this video challenged the way you think about real estate, type "Now I see it" in the comments. Seriously, I read every single one. And I love seeing who's out here rethinking the rules instead of blindly following them. Because the first step to building real wealth is to start asking better questions. But here's the thing most people still don't realize. The problem with real estate isn't just the return, it's the friction, the emotional weight, and the invisible cost of your time. Because unlike stocks, which are cold, fast, and logical, real estate is slow, messy, and deeply personal. And that's exactly what Warren Buffett warned about next. Let's break down why he believes that owning a home isn't just inefficient, it's an emotional trap disguised as a financial strategy. Let's step back for a moment. This isn't really a video about real estate. It's a video about awareness, because the real cost of buying a home isn't just the mortgage, the taxes, or the maintenance. It's the opportunity cost of where that money, and more importantly, where your energy, could have gone instead. Warren Buffett doesn't criticize home ownership because he thinks homes are bad. He simply refuses to confuse comfort with capital growth, and that's what most people do. They buy into a cultural narrative, a beautiful lie, that says, if you own a house, you're winning. But here's the truth Buffett sees that most people miss. You don't get rich by owning things that cost you time, money, and peace of mind. You get rich by owning assets that require as little effort as possible, generate consistent income, are easy to scale or exit, and grow in value faster than inflation. Most primary homes don't do any of that. Yes, you can get lucky with appreciation. Yes, you can rent out rooms. Yes, you can turn it into a business if you're strategic. But let's not kid ourselves. That's not what most buyers are doing. Most are buying at the top of their budget, in high-rate environments, hoping that time will turn the purchase into profit, while draining themselves month after month just to keep up. That's not investing. That's gambling with a pretty paint job. So where does that leave you? Should you never buy a home? No, that's not the message here. Home ownership can absolutely be meaningful when it's done with intention. But you need to ask the right questions. Am I buying for freedom or for validation? Does this home serve my financial strategy or just my emotional need? Can I own this house without sacrificing my ability to invest in other wealth-building assets? And most importantly, is this going to move me closer to financial independence or deeper into quiet financial stress? Because Buffett's warning wasn't just about real estate. It was about how easily people fall into decisions that feel right but compound in the wrong direction. He saw it during the tech bubble. He saw it during the subprime mortgage collapse. He sees it now in people stretching to buy overpriced homes with expensive debt, thinking they're building wealth when they're just burying it. And if someone who built $130 billion in net worth is stepping back to say, there's not as much opportunity in housing anymore, maybe that's a clue. Maybe you don't need to own the house. Maybe you just need to own your strategy. Because at the end of the day, wealth isn't about where you live. It's about how you live. And the people who build true wealth, they don't chase symbols. They chase leverage. They chase clarity. They chase freedom. So here's the question. Now that you've seen the numbers, the mindset, and the warning straight from Warren Buffett himself, what will you do differently? Will you follow the default path? Buy a home, call it an investment, and hope it works out? Or will you pause, ask better questions, and build your wealth on purpose, not by tradition? If this video opened your eyes, do one thing right now. Share it with someone who still believes their house is their greatest asset. It might save them years of financial stress or hundreds of thousands of dollars. And if you want more content that challenges conventional thinking and helps you build real, quiet, unstoppable wealth, hit subscribe and turn on notifications. Because here we don't chase trends, we follow principles, and we build wealth the way Buffett did. Not loudly, not quickly, but intelligently. Your future doesn't need another mortgage. It needs a strategy, and it starts now.